Welcome to the November RCA Institute discussion and webinar. My name is Larry White. I'm the director of the Resource Consumption Accounting Institute. And today I'll be presenting on the importance of capacity information in RCA, both how important it is to RCA and how RCA improves the information that's available to you. Then, and as I go through the presentation, if a question pops into your mind, I encourage you to use the chat feature. However, at the end of the presentation, I will take everyone off mute, or I guess nowadays they've changed the system. I will ask everyone to unmute. And if you wish to chime into the discussion with a question, comment, observation, you're welcome to do so. Now, for those of you that aren't that familiar with RCA, let me just give you, this slide presents a quick overview. RCA is based on two core ideas. First, for capacity analysis and management, and a lot of marginal costing, it draws many insights from German management accounting known as GPK, or Grenzplan Kostenrechnen, and it also incorporates the process view advantages of activity-based costing. If you're not familiar with GPK, that's not surprising. Not much about it has been translated into English. The focus of RCA is internal management decision making, which is similar to GPK. We seek to link operational information and metrics to financial information. And by financial information, I mean monetary information, not necessarily the information directly in regulated financial statements. And when building RCA models, one of our goals is to maintain clear cause and effect relationships. This was a costing continuum levels of maturity model put out by the International Federation of Accountants some years ago. And as you can see, it recognized resource consumption accounting as extremely sophisticated in terms of demand-driven planning and capacity sensitivity. It did rate full real-time simulation as higher. However, I would argue that if you want to do full real-time simulation, you're going to need to use RCA modeling in most cases. But of course, that'll be a discussion for another day. This is the IMA conceptual framework for managerial costing. And it deals with the two core principles for producing information for internal decision support. Actually, the core principle for modeling is causality. And the idea is that you create an operational model that is costed. And that's also what RCA seeks to do. And then you use that information and that model as your baseline optimization information. And of course, you inject changes into that to try to improve. The second principle is analogy or information use, and there are some concepts to that. Today's presentation will be focusing on capacity, one of the concepts that supports causal modeling. So, since we're talking about cost, one of the questions we need to talk about is what causes costs? It's a fundamental question. Businesses incur costs to acquire and use resources. Now, resources also create all the revenue for an organization or create the effort that puts them in a position to collect revenue. Sorry for the pause. I had to let someone else in. The generally accepted accounting principles and financial accounting and reporting tends to focus on dollars. And dollars can make you forget that if you want to change your costs in an organization, it requires changing the use and or mix of resources. I also have that issue a little bit with activity-based costing. It puts a focus on activities when, if you want to save cost, the focus really needs to be on the resources. Now, admittedly, you got to do something to activities maybe to have less resources, but it is resources that are the cause of costs. So if resources are that important, what are the primary characteristics of resources? Well, I list three. First, I list capability, and that tends to be a little bit about the quality or qualitative characteristics of a resource, which generally aren't modeled in costing. They are probably modeled operationally. And what do I mean by this? Well, take an accounting technician. You can have one accounting technician that is incredibly fast. It can whip through a bunch of simple transactions. And then you may have another accounting technician that's not nearly as fast, but is absolutely wonderful at working out the problematic transactions. And doesn't mind doing the research and can go through those with a great deal of thoroughness and insight. So both of those are accounting technicians. They may be both paid the same because they're both excellent employees, but they have very different characteristics. And then, of course, capacity, which is what we're talking about today, is the quantity, normally in time, but it can be units of output that a resource provides. And then finally, the third characteristic is the consumption or cost characteristics associated with that. Normally, I think of that in terms of fixed and proportional costs in relation to the output. And that's not only fixed and proportional cost, but it's what other resources are consumed. You may have two machines that do the same thing that require a different amount of people, a different amount of maintenance, and things like that. So what are the consumption and cost characteristics and the cost behavior? So today, of course, we're focusing on capacity. So how do we define capacity? Well, I like the Consortium for Advanced Management International, KPIs definition of capacity. They use the terms productive capacity. That's when a resource is doing the thing you hired it to do. Okay. For instance, going back to my accounting technician, when that accounting technician is processing accounting transactions. Non-productive is things that a resource must do or must spend time on, but they're not the reason you hired it. For instance, our accounting technician is going to require some training. That's non-productive. Not non-important, just non-productive. And finally, there's idle and excess capacity. And that is when our accounting technician simply doesn't have any productive work to do. people go out and they find busy work to do, like cleaning up their desks or various other things. But let's be clear, it's when there's no productive work or non-productive activity for a resource to do. So these do lead to a couple of questions, particularly idle capacity. And that is, what do allocations of idle and excess capacity do to costs? Because a lot of times you just assume that all the cost of a resource is consumed by the activity they put out. And of course, that overcosts the hours, especially if there's idle or excess capacity. If you don't identify idle or excess capacity specifically, if you don't identify non-productive capacity, then you layer all those costs onto productive capacity. And you need to think about the impact of that. So the other question that comes in is, who's responsible for idle and excess capacity? This is a big issue because employees, particularly supervisors and work teams, tend to hide their excess and idle capacity because they don't want to be yelled at for being not busy or for doing nothing, or they don't want to be tasked with more things to do during what they consider just to be a temporary lull. So really the responsibility for idle and excess capacity rests higher up in the organization. And in fact, managers and employees should be rewarded if they do the work that's assigned to them faster and more efficiently. However, as we all know, that's not typically done because in many cases, idle and excess capacity simply information is not collected. Now, this is the CAMI capacity model, if you're not familiar with it. Of course, down in the green, you see the productive capacity. In the red, you see the non-productive capacity. Now, of course, non-productive capacity is essential, but needs to be optimized. So you have to do it. You need to make it as efficient as possible. And then idle and excess capacity really is neither good nor bad, but particularly from an accounting point of view, it needs to be visible and it needs to be evaluated for potential productive use. So, one of the other goals I mentioned earlier was connecting operations and finance or money. Now, the way I like to look at this is that there's two views of the world. There's an operational view, and then there's a traditional financial view, which I think of in terms of, regulated, required financial statements, traditional financial accounting. And there's some differences there. The operational view and operational systems tend to operate in real time because they want to stop bad things from happening before they produce or sell more of these flawed products or services. Financial reporting time tends to happen when the financial system puts out the information, like payroll comes out every week, 2 weeks, or every month. And that's financial reporting time. Reports are done every month, not continuously. The operational view, as I said, is action-oriented. They want to take immediate action. The financial view tends to be report-oriented. Somebody presents the report, gives people a time span to make improvements. And of course, the report usually is somewhat after the fact, maybe 2 weeks, maybe a week, maybe a few days, but it's after the fact. And then you have to wait until the next reporting period, part of which is consumed by the time spent developing the report. The other thing is the operational view is internally focused. It's focused on the company's operations primarily. And the financial view is typically externally focused because financial accounting and reporting tends to be designed to support external financial reporting. So it doesn't feel obligated in many cases to keep the level of detail that supports the operational view. So how do you connect these two? Well, most financial views are focused on the cost of products and services. There are other ways to do that. You can connect with processes and value streams. You can look at intermediate outputs along the way, but the purest connection is at the resource level, because if you go to the resource level, typically the operational view and the finance view tend to connect and be very similar at a drill down level. They may be, the financial view may frame things differently than the operational view, but the resources are fundamentally the same. So let's take a look at an example to get a sense of what I'm talking about how RCA thinks of this and about how RCA models models capacity. So what we have here is at the bottom, kind of two rows at the bottom, we have a production line. Then, whoops, up above, we have supporting resources. So you also on this chart see some lines. Now the lines are pretty much limited because I'd have tons of lines if I drew them all in to the purchasing resource pool and the machine maintenance resource pool. And I did that just to keep things clear. And then I put the lines down in the production area. So the product over here at the end draws resources from the production pools and, of course, the raw material. The production pools tend to draw resources from each other and from some of the support resources. And the support resources tend to support each other to some extent. What RCA models do is we identify the capacity of all resource pools and the resources within the pools, not just the production, but all of them very specifically. And then we model the flow of those resources in operational units, such as hours or pounds or whatever. You can see we've put those in there: square foot for floor space, kilowatt hours for energy, man hours for human resource support, and so forth. Let's take a detailed look, if you will, with me at the packaging operation and get a little bit clearer picture of how we look at the capacity there. So we have a packaging machine. The theoretical capacity on that packaging machine is it's available to the company 24 hours a day, 365 days a year. The transport equipment used to move things around, again, available since we own it 24 hours a day, 365 days a year. The packaging material and packaging supplies, they're unlimited, as much as we can buy. The supervisor and the technician labor associated with the packaging operation are available 8 hours a day, 5 days a week, 300, and you multiply that times 365. So they're not available that many days. And of course, they would have sick leave and vacation leave, which would be unproductive time. So I hope you get a sense of that. That's the way we look at these resources first, with theoretical capacity. And then we subcategorize it, like I said earlier, into productive, non-productive, and idle or excess, and apply those things thoughtfully. Now, you may be asking, what about overtime? Overtime's probably available, especially at the technician labor. And yes, and the way we would tend to model overtime is as a separate resource pool. Why? Number one, it's typically at a different rate. And we can argue this, but there's typically a bit of a capacity associated with that. You can burn out your workforce with too much overtime. I'm sure most of you have worked in a big service processing facility or manufacturing facility are aware of that. So I want to go back over the RCA modeling approach so we can kind of fit this into perspective. The simplified method is 3 steps. First, you model the resources, their capacities, and where they are consumed, or what's their output. And you usually do that not at individual resources, but usually group resources together into resource pools and model it from there, ones that have homogeneous output. Then you model the quantities of resources consumed and the nature of that consumption. In other words, as the output varies, is the resource a fixed? Does it change, or is it consumed proportionally? At this point, you have created a quantitative, non-financial, cause and effect based model of your operations, and you can see the resource capacity issues and probably some opportunities. The third step is that you apply costs to the flow of the quantities and the nature of that consumption. And I hope I've given you a little bit of a view about how that's done. So I hope you've achieved some understanding of how RCA focuses on capacity and can make better connections between operations throughout the organization, not just product or service producing operations, and finance, or the money that's associated with them. So I'm going to, well, first I'll take a look at the chat. I see a question. Nope, it was just from one of the attendees who left early and sent me a nice note saying she had to leave. So I'll take everybody off of, or I'll ask everybody to unmute and encourage anybody to ask me a question or comment or a discussion item. So you're all welcome to do that. Let's see, one of the questions I typically get, and I think I answered this, is this just for product and service costing? And the answer is definitely not. I think I mentioned that in RCA, we strongly recommend that the entire organization be costed and causal relationships throughout the organization be examined. Are there any other comments or questions?
Larry, this is Dan Hill with Altavia Consulting. You mentioned with the capacity for a machine, if we own it, it's 24/7, 365 days a year as its capacity, theoretical capacity. Now, but if you lease or rent a machine, do you use the same theoretical capacity?
Well, that would be dependent on the lease agreement. So, you know, there again, you may have, you may be limited to a number of hours that you can use that. So maybe you leased it for, 2,000 hours, in which case that might be your theoretical capacity, and perhaps there's an upcharge associated with going over that, which you'd then have to model as a as a separate cost pool if there was a different charge associated with that. But so I think the answer to your question would be a no. You have to look at the lease agreement. Does that make
Hey,
sense?
that's good. Yes.
It would be the same with, if you have contract employees, it would, your limitations on them would be the contract with that company as opposed to your normal employment agreement.
I do have another question if no one else
Sure, go
does.
ahead.
And I've sort of asked this question before, but if you have a plant that's operating 2 shifts, and let's say that your machine is not being used for 10 hours during those 10 shifts, but when you look at the excess capacity of that machine, it's not 10 hours, it's 40 or 50 hours because you're not running a 3rd shift, you're not running something all night long. Don't you think it'd be more helpful for them to know within that 2 shifts what their excess capacity is rather than against a theoretical limit that's really not being utilized?
And there's probably a need for that information. I would say yes. However, I've run into the situation personally where people become so locked into the current level of operation that if they get an opportunity to expand, let's say take on new business or develop a new market opportunity, a lot of times they will instantly think, they'll say, oh, we're at full capacity because we're operating 2 shifts, and they kind of forget about the 3rd shift or the availability of that 3rd shift. So my answer is that you may want to adjust your metric to show how well you're doing during those two shifts, but you always want to point out that 3rd shift is sitting there. It's costing you some money to have that equipment sitting around and not be using it. Now, what a lot of companies do, manufacturing companies at least, is they'll run 2 full production shifts, and then they'll do their maintenance or daily cleanup. Food plants do this a lot during that 3rd shift. Admittedly, they don't have everybody in there they don't have people in there for 8 hours, but they have a crew in there that is in there doing non-productive activities during what would be otherwise idle capacity. And, that's a smart thing to do, but that comes from having an awareness of the fact that there is some idle capacity time. Does that make sense, Dan?
Yeah, that was good. That was a good answer. Can't say I totally agree with you, but I think that's a good answer. Larry, thank you.
All right.
Hello, Larry. This is Freddie.
Freddie, how are you?
Fine, thank you. And you?
Great.
I have a question related to DUNS. If I have a machine during the runtime, the expenses related to the time should be related to the product. But what about a downtime? I have a couple of clients that they put some sensors in their plant and in their facilities, and they can monitor the downtime. That could be for several reasons, but they can measure the downtime. My question is, this downtime should be related to the product, or should be not related to the product?
Well, so it depends on the reason for the downtime. So what I would say is, and again, as in all things in management accounting, you can split hairs to an infinite level, and at some point you have to draw a line around how material it is. But generally speaking, maintenance that's associated with running a machine, for instance. So you have downtime for maintenance that would fall into non-productive time. That clearly emanates from the fact that you're creating product. So that the causal relationship would be associated with producing the product. However, if you have maintenance that's required simply because the maintenance has to be done every 3 months, whether it runs or doesn't run. One could say that if the plant runs 2 shifts rather than 3, only 2/3 of that kind of maintenance would be associated with a product. Now, you have to ask this question: is the amount of money or the resource time we're talking about sufficiently material to draw that kind of distinction and collect that kind of information? And that's a judgment call, but that's the way I look at it. I mean, I think of if you're going to have a depreciation charge, or what I prefer to think of as a capital preservation allowance on equipment, and you need to do that based on, and if you do that based on time, then a third of your capital preservation allowance might be a cost of just having that equipment. So only 2/3 of the capital preservation allowance should be applied to product. The other part would be applied to idle capacity. Again, you need to think that through. What kind of equipment do you have? Is it relatively timeless in that, or is it, and some people do capital preservation allowance associated with the number of hours the machine runs, in which case then it's much more clearly assignable to product. So there are decisions to be made in this area, but as I always say, you need to think through these. You need to say, what is the causal relationship that's driving the incurrence of this cost? And if it's significant, then you need to adjust your model to collect that. If it turns out the number is truly insignificant, then maybe you don't bother collecting that. Does that make sense, Freddie?
Yes, pretty good. Thank you.
Okay, any other questions or comments? Well, I want to thank you all for hanging with.
Hi, sorry.
Sure, go ahead, Andrew.
Yeah, my name is Andrew. So I'm new to this RCA notion. I just kind of found it on the web a couple of weeks ago.
Well, I'm glad you did.
Very curious about kind of what it's about. And so a couple of questions. One, you mentioned like modeling and such. Is there any like software tools that are commonly used for this type of modeling, or are you implementing these models in Excel, or what kind of approaches or tools are?
Okay, yeah, there's a number of options. There are softwares. Actually, SAP can support, in terms of major software vendors, can support RCA modeling, although it's not that simple to change an RCA setup that's not set up to do it. As you know, nothing about changing SAP's cheap or easy. There are, some middleware software packages that do this, that can do RCA. One of them that I'm most familiar with is something called Max Controlling, MACS, and controlling. It's out of Germany, but does have a sales office in the US. And then there's, matter of fact, Dan's company, Altavia Consulting, has a kind of a decision. What do you call that? It's a database tool that allows them to readily customize to an organization's model and allows a lot of data pooling from various operational and financial systems. And we have seen it done on spreadsheets in some for smaller organizations. It can get incredibly complex for a large organization. Does that kind of answer your question?
Yeah, that's great. So my other question, I mean, this is kind of a broad question, but when we look at just like a sort of traditional like P&L type accounting model, and we're sort of thinking about like the levers that affect like the ultimate profitability of the company or operation, from between like the kind of the top line and the bottom line, there's all these different effects, and in like in a business that has a small operating margin, small changes in expenses can have like a multiplier effect on the end profitability.
Yes.
So in the case of like the RCA modeling, is there kind of like, is that kind of the end goal, is to kind of like find these sort of like points of leverage where like making small adjustments can have like a big impact? Does that make sense?
In a way, I'm going to give you an answer, and then you tell me kind of if I answered you.
Okay.
So it won't be long, so
Yes.
you should be able to correct it. But so RCA, when somebody wants to map back to their financial reporting numbers, that's usually going to involve a good many adjustments to various sorts of numbers due to the way it's applied. We recommend different depreciation than what your financial accounting would use. We recommend a lot of things that have causal relationships to product cost be applied to product, be applied, that GAAP would never accept. So there's going to be a lot of differences because we take an internal decision support point of view focused completely on causality. And if you remember back to your financial accounting education, causality is actually not a concept that financial accounting or generally accepted accounting principles explicitly applies. So there's going to be a lot of differences. I'm going to stop there. I could go on, but I want to say, am I talking in the ballpark of what you wanted to hear?
I think okay. I think I'm just sort of I'm interpreting kind of what you're saying.
So let me give you a more specific
map
example
for interpreting RCA versus traditional accounting. So there's this emphasis on causality. You're probably pushing more costs into the cost of goods.
Yes,
that model.
it would tend to do that.
Mhm.
Yeah. But then it would take costs away from SG&A types of things, right?
Yes.
And what it would do, what we kind of focus on is building an accurate, much more accurate incremental and marginal costs. So, one of the effects we find in some companies, is that they tend to overcost or undercost things because of just the way they peanut butter spread their overhead allocations. And in some cases, the way they don't apply costs that are considered SG&A, but do have a causal relationship to to product cost. So um, you're going to find some differences, especially in short-term financial statements. Over the longer term, the differences would tend to, come to, I mean, they would tend to come together a bit. In other words, the margin, the profit margin that RCA predicts would tend to come true over time, in financial statements, but it may be a very different time because financial statements place period costs management ahead of causality, for instance.
Larry, if you don't mind, I'd like to take a little different twist on answering Andrew's question. Maybe I didn't fully understand your question, Andrew, but RCA can definitely be used to look for operational opportunities, become more efficient, and pull some of those levers you mentioned to improve the bottom line of your company. But one of the things I really see, the value I see in understanding causal costs in RCA is understanding your customers. I grew up in the banking industry, and we used to assign profitability to customers based on their products. That was very misleading because although two customers may have the same checking product, one might visit a branch 10 times a month, the other person doesn't come in at all. So their costs can be very, very different, even though they're using the exact same product. We did not understand that until we actually took our costs down to the customer level in a causal base so we could understand our customers. And there's actually been a lot of research done on this, Andrew, where most companies don't understand this, but a good 20 to 30% of their customers pretty much provide all their profits. The other 60, 70% of their customers are either break even or losers. And this is not in the banking industry. This is, now this research is about 20 years old, but it went across all industries. And that was Robert Kaplan that did that. And I was just amazed. I've done a lot of ABC and RCA costing analysis and models since then. And I see this every time I build a model. A huge percentage of a customers are either of our clients' customers are either break even or they're losing money. So until you drill down all the way down to each individual customer on a causal base, you're not really going to understand what your customers are costing you and really truly how to pull the big levers to improve that bottom line.
Interesting. Yeah.
Does that help you, Andrew?
Yeah, that's interesting. I mean, so it can kind of maybe help you identify a market segment that's actually profitable and shed that which is not.
Yeah, absolutely. And which type of customers to go after and which not to. The problem I have with segmentation, Andrew, is I tend to see a lot of it's based on demographics because that's easy to get your hands on, and it's about and it's about the least valuable type of information to use to segment customers.
People have used it for distribution channel costing in roughly the same way as Dan described for customer costing. So that works. I mean, some of the things, we've had some medical applications, because they have big expensive equipment that, tends to sit idle for good chunks of time. And, there have been cases where, hospitals or clinics have offered relatively discount rates for people to come in at 3 a.m. to get their MRIs and stuff like that. So, there are some insights that come out of this that show people where there is some capacity or some differences in the way they're looking at costs today once they apply truly causal modeling to it.
What about like advertising, and specifically like digital performance advertising, where you can correlate maybe individual customer activity with ad spend?
Yeah, that's a growing area that people are looking at. In fact, I worked with a German consulting firm that's very focused on this right now. From their GPK days, they're trying to help some consumer goods customers get a handle on how to apply, the costs of their digital advertising. And they're looking at, individual consumers, customers, how much can you group them? How do you apply those costs causally to make some most sense in terms of your operation and your profitability?
Mhm. Is a business's cash reserve considered a
Well, there are
a
RCA
resource?
models that apply a cost of capital
Okay, yeah, that's what I'm getting at.
in the modeling, and that's certainly an achievable and doable thing.
Mhm.
I know Dan's boss, Anton Vandermeer, used to work in the airline industry, and that was kind of a big deal with them because they have these massive investments, a lot of which are bought on leveraged, bought on credit, and they were always looking at the cost of capital associated with the equipment.
Mhm.
Yeah, the hard thing there is allocating the capital down to your subunits. That can get very, very tricky.
Well, a lot of times you just
with
build it
Bank of
into the
America.
cost of the resource pool.
I'm sorry?
You build it into the cost of the resource pool.
But it's hard to know how much of the capital you can see what the total capital is for the company, but assign it down to your lines of business could be tough. I used to work at Bank of America. We had an army of statisticians, really PhDs and statisticians. We had 5 or 6 of them that were doing this capital assignment stuff every month. It was pretty crazy. But once you've got the capital assignment,
like
you can
very
decide
abstract. It's kind of an abstract notion, right?
But
It
it's
is.
not
It
that
is.
abstract.
Sure.
If I could bring out an example, let's say, you're a manufacturer, and some of your products you simply buy and resell, like a retailer or a wholesaler, I guess you'd say. And another proportion of your products you actually do engage in some sort of manufacturing process. Well, you need to get a bigger markup on the things you manufacture than the things you just buy and resell, because you have a lot more capital invested in that, right?
Mm-hmm.
So that's where, if you just take, you can do it fairly grossly and just take, what are the expenses associated with the resource pools doing the production, and pretend that's all a use of capital. You don't need to limit it to just capital equipment. It's consuming capital compared to the few purchasing agents and salesmen that are involved in going out, buying, the warehouse that stocks things and then reselling. And, so I have a friend in Michigan who's worked with a lot of, particularly small manufacturers, and he always advocates, when they have a mix of things that they buy and resell and things they manufacture, that they apply the capital associated with the things they manufacture.
So that's one type of capital, your machine and your facilities. But what we dealt with a lot
even
of,
the labor consumed, if you think about it, is a drag on working capital, right?
yeah, I suppose. In the banking industry, our bigger problem is risk. We had to assign risk out to all the different lines of business, and that gets very, very, very tricky. But yeah, Larry, no, you make a good point. I think for some companies that's not a big deal, and it's a little bit easier to assign that capital, come up with a discount rate, and you can attach a cost of capital.
Yeah,
and you don't have to embed it into your unit costs.
Yeah, it kind of depends on the the variety of businesses you have, and making sure you're doing the kind of business that is profitable for you.
Agreed.
And if there's a big difference in the amount of capital applied or the resources applied to one of the businesses, then you don't want to go strictly on a profit as a percent of sales, because that'll warp your your information.
Agreed.
So
Yep,
in
the
the
game is really return
RCA,
on capital. I'm sorry, Andrew.
yeah, sorry, yeah. In the RCA, this is all very helpful. Thank you, guys. In the RCA model, what are the sort of top 3 KPIs, to inform management that kind of come out of applying this? Is it like utilization, or I guess you were saying marginal?
Yeah, we kind of go with profit
cost.
with margin. So what RCA typically does is it creates a multi-margin P&L. So for instance, if I'm going to take a manufacturing example because I can rattle this off faster than I can do anything else. But
Yeah.
so your first blush would be, sales minus what we call proportional or variable expenses for the product. Your second margin would then be you'd subtract out the fixed costs associated with the product. Then, if you're set up so that you have multiple products, the next margin might be the proportional costs associated with the product group. And then the fixed costs associated with the product group. And if you have a product family, because, some of your advertising costs, for instance, you can clearly identify to a product, whereas some of them may just be brand name for a product family. So, what we do is we segregate these margins down and we look at where to apply information based on where the costs are in the organization. So you'd come up with a purely product margin, then you'd be hit with the causal margin costs that are associated with the product family. So you'd lump all the other, products together in that, I'm going to say product group. Then you'd put the product group, then you'd maybe lump the groups together into a family and you'd show the information, the costs that are associated with the family. And you'd kind of go through that kind of margin analysis so that you could understand where the costs were coming. And, for this one, we look at, when you look at idle and excess capacity costs, sometimes, people build plants too big because they think they're going to have expansion, or they build in too much capacity, they buy too much building or whatever. And, we suggest that those costs be associated with not the product, but with the level of the organization that, can actually change that decision, could sell off that space, could sell off some of that capacity and things like that. So you don't lump idle capacity into a product cost when in fact it's not something the people that are producing the product can control.
Okay, great.
And Andrew, I'm not sure what kind of business you're in, but if you'd like to talk some more about this, my contact information's up here. I'd be happy to sit down with you. And
Yeah, great.
And if if that's useful, if you want to go over your specific situation a little bit more and see how it might apply.
Yeah, my background is in like e-commerce and sort of consumer goods.
Oh,
but,
okay.
right now I'm in between 2 businesses. I'm just starting a new one, so I don't have a lot of need for fancy accounting at the moment. I'm just surfing around and kind of learning stuff. So
well, that
yeah,
you might
great.
be interested in that. I wrote the introduction to this to that German book I was talking about, the German consulting company. And if you email me, I can send you a link to that one with the ISBN number and all.
Okay.
They published it, and I think it's listed with Wiley or someone like that. And it's actually all about the consumer goods space. So if you want some more information on that, it's written
Yeah,
from
great.
kind of a German controlling point of view, which is very much like GBK and RCA. But
Mhm.
they had a bunch of their consultants write a series of articles in there, and you may find that very interesting.
Great. Well, thank you.
Just email me. I'll send you the link to
Okay.
where you can find the book.
I'll do that. Great.
All right. Well, everyone, thanks for hanging in there. I'm going to call it a day. We'll be doing this again next month, where we kind of do a fun one about what constitutes truth in management accounting information. And that usually stirs up a little controversy. So I encourage you to come and listen if you're not familiar with that topic, or if it sounds a little bit interesting to you. Thank you.
Larry, great webinar. Thanks so much.
All right. Bye.
Bye now.
Thanks, everyone.